I've been pleasantly surprised at how free cash flow margins have actually been holding up. In 2018, they were actually up. I mean, through this whole cycle has been a margin-driven cycle. And people have made this call so many times. Margins are going to roll over now. Margins are going to roll over now. What makes you so sure that this is actually the time that you actually see margins roll over and 2019 margins are lower than 2018?
What's happening, number one, so the fourth quarter was the first quarter where companies now are guiding lower on margins by 70 or 80 basis points. The way we track it for calendar 19. We look at operating margins,
so
free cash.
For Q1, but what are the chances that they beat those and then we sort of...
Well, I mean, I think we don't know, right? But I think the trajectory is a change. So here's the way we set up the storyline is we think last year they overheated the economy with the fiscal stimulus. We got to 4.2%, GDP growth, which is well above potential GDP. That created cost pressures in the supply chains. It also created cost pressures in the labor markets. And now companies are reacting to that, as they should and as they probably will. That doesn't mean a recession, but it does mean we could see a cutback in some of these areas where they probably overspent. And that leads to, probably margin degradation. Is it a collapse? No, but it's not in the numbers, and it's starting to get into the numbers.
Well, I would counter that just a little bit. I think, you point out, obviously correctly, the 4.2% GDP print. For the year 2018, 3% GDP. I don't really consider that overheating. I think it was maybe a little bit of a boost from fiscal stimulus. We at this point are, I would characterize it as constructive on equities, but guarded. So we're actually thinking that it's quite possible we're in a bottoming process for global growth. We've gotten some mixed data so far. China was at the epicenter of the slowdown for 2018. Came from aggressive tightening in 2017. And they've been stimulating through the process of this year and last year. That occurs with a lag, so we think that we could be seeing some of that start to filter through. Perhaps it's already started to filter through. Some of the data's coming in mixed in January and February. Of course, I'd caution that the data so far, I would characterize it as seasonality on steroids, because we had a fourth quarter typical seasonality issues, which may be at play with the retail sales in the fourth quarter. Normal holiday activity, a government shutdown, a stock market sell-off, all of this is making it very difficult to discern the underlying trend at this point. Hence why I think we're a little bit guarded. We took a little bit of risk off the table at the end of January. But I think in this type of an environment where you could see volatility shift a little bit higher, you've got to be looking at quality, that high return on equity, stable earnings, and low leverage.
Doc, what do you got?
Mike, I'm going to throw back your own words to you. As you said, maybe up to 45 times we've heard about China. I agree. That's because the deal isn't done. The Fed is the driver because when Jerome Powell made his pivot, that's what we've reacted to. So I'm going to push back on China priced in because it's not. China can't be priced in because we have no idea what the deal is yet and if and when it gets enacted. So I'm going to say that could be the catalyst that takes us through your upper end target. You're not saying we can't ever do that. I'm just saying I think that's what it is. Powell, we already know, and he told us very clearly what he and the Fed are going to do. China, we have no idea.